Why regulation is necessary for any financial market? Let's look on the example of the stock market crash of 1929. Most of us don't remember this, but it was a time when millions lost their saving, unemployment in the United States hit 25%, and many people struggled to pay off their debts. The truth is, if there had been regulations in place before the 1921 crash, they could have helped prevent some of the problems that led to the crash. Regulation would have made things more transparent, limited risky trading, and protected people from fraud. After the crisis, the US government created the Securities Act in 1933. This law made companies share accurate information about the stock and bond they were selling to protect investors from being misled. The following year, the Securities Exchanges Act of 1934 set up the Securities and Exchange Commission, SEC, to enforce these rules, oversee stock markets, and keep trading fair. The need of regulations in financial markets. Without regulation, we'd suffer chaos, manipulation, and catastrophic loss on all fronts. Regulations, after all, are the governance for everything from currency exchanges to commodity trading, ensuring that market operates smoothly and that participants are protected from undue risk. Currently, established rules govern stock markets and commodities like oil and gold. However, when it comes to cryptocurrency, even the basic task of defining it presents significant challenges. Cryptocurrency doesn't fit neatly into any existing category. This makes it exciting but also challenging because we need new rules to manage the misfit as it grows and becomes more important in the world of finance. Let's explore the challenges of regulating crypto and what might be the ultimate solution. Crypto is a currency. Is crypto a currency? Not really. Only a few countries such as El Salvador and CAR have recognized cryptocurrencies like Bitcoin as a legal tender, meaning they can be used just like regular currency to buy things or pay taxes. But this is risky because crypto value can change a lot, making them unreliable as a stable currency. As such, some other countries allow cryptocurrencies for payments, but don't recognize them as official money. But why, you ask? Aside from volatility, there are two main reasons. Lack of control. Central banks cannot control cryptocurrencies, making it hard to manage the economy. Regulation issues. The decentralized nature of crypto makes it hard to track and regulate, which can lead to illegal activities. Crypto as a security. Could crypto be a security? A security is something like a stock or bond that allows ownership of a loan. In the United States, the Howley test is used to decide if something is a security. It looks at whether there is an investment of money, if the investment is in a common enterprise, if there is an expectation of profit, and if the profit comes mainly from the efforts of others. Some cryptocurrencies like Ethereum, during its early days, might have fit this definition. But as Ethereum became more decentralized, it no longer met all these criteria. The big issue is with calling crypto a security R. Decentralization. Many cryptocurrencies operate on networks without central authority, which doesn't fit the usual idea of a security. Regulation burden. Security regulations are very strict and could limit innovation and the growth of the blockchain technologies. Crypto is a commodity. What about calling crypto a commodity, like gold or oil? In the US, the Commodity Futures Trading Commission, CFTC, classifies cryptocurrencies as commodities. And this makes sense. That's why. There is fungibility. One unit of cryptocurrency is the same as another, just like trading commodities. And there is trading. Cryptocurrencies are traded on exchanges similar to commodity markets. But even this isn't a perfect fit. Commodity regulation don't fully cover the unique aspects of digital assets, like their decentralized nature. It's like trying to fit a square peg into the round hole. Let's take a closer look at how different countries are approaching crypto regulation. Around the world, regulators are working hard to create rules that make sense for this new type of asset. While some are more advanced, others are still figuring things out. The European Union has taken a big step towards with its markets and crypto assets, so-called MiCA regulation. Officially adopted in April 2023, MiCA is one of the first comprehensive regulatory frameworks specifically designed for cryptocurrencies. MiCA separates crypto assets into three categories: asset reference token, electronic money token, and other crypto assets. Each type has its own set of rules to ensure that different digital assets are regulated according to their unique properties. MiCA sets strict rules for crypto companies, including requirements for transparency, risk management, and safeguarding customers' assets. This is meant to protect users and make crypto markets safer. The regulatory framework also addresses market manipulation and other abuses by requiring companies to implement systems to detect and prevent these issues. This helps to keep the market fair for everyone. In the US, the approach to crypto regulation is still evolving. Agencies like SEC and CFTC, which we mentioned before, have taken the lead in overseeing different aspects of the market. This has led to several high-profile cases, where the SEC has taken action against companies that it believed are selling unregistered securities. Meanwhile, the CFTC treats cryptocurrencies like commodities and oversees trading in futures and derivatives. The CFTC approach is more hands-off, allowing the market to develop while still preventing fraud and manipulation. Asian countries are also actively working on crypto regulations with varying approaches. Japan, for example, is one of the most advanced in terms of regulation, recognizing Bitcoin and other cryptocurrencies as a legal form of payment. However, they are not considered legal tender, and strict rules are in place to protect consumers and prevent money laundering. China, on the other hand, has taken a hardline approach by banning all cryptocurrency transactions. Despite this, Chinese citizens still participate in the global crypto market through decentralized finance, DeFi, and other means. Also notably, El Salvador made headlines by becoming the first country to adopt Bitcoin as a legal tender in 2021. This bold move allows citizens to use Bitcoin for everyday transactions, alongside the US dollar. However, this also raised concerns about economic stability and the impact on the country's financial system. Around the world, there is a push towards harmonizing crypto regulations. As different countries develop their own rules, there is a growing need for international standards that can ensure consistency and prevent regulatory arbitrage, where companies move to countries with less strict rules. A need for a global framework. The truth is, cryptocurrency need their own set of rules. Traditional concepts like currency, security, and commodity don't align well with the unique nature of digital assets. While we've recognized this challenge for some time, developing a new framework has proven to be difficult. However, progress is being made. If they use MiCA, markets and crypto assets, regulation proves successfully after its launch, it's likely that other regions will follow suit, adopting similar approaches. To keep this lesson relevant, we'll be updating the reading periodically in the description of this video, so be sure to check out.